Good morning, friends. Okay, today we're going to start with a new chapter which is on mutual funds. Before I start with the chapter, we are done with security valuation. You will have to complete the theory part of security valuation by watching that video. Also, complete chapter 1, 6, and 14 theory. These three are the most important chapters from theory point of view. If theory comes for 20 marks, around 12 marks will be from these three chapters, chapter 1, chapter 6 and chapter 14. Most of the exams till now, two questions have come from these three chapters. So 2 to 3 questions will keep coming. Chapter 14, one question mostly keeps coming. Chapter 6, one question keeps coming. Chapter 1, 1 and 2 attempts. Most of the attempts, there is one question which has come from chapter 6 or chapter 14. Sometimes they may ask a different chapter. For example, the latest attempt they ended up asking more theory from chapter 11, which was not a theory focused area. So I cannot do a selective preparation and all, but I wanted you to give some extra importance to chapter 1, chapter 6 and chapter 14. They're extremely critical from theory point of view. So complete preparation of these three chapters, theory as well as security valuation. Keep watching the video multiple times till you get clarity on the theory concepts and keep revising it on frequent basis. The only way of preparing theory is preparing on a continuous basis. So if you prepare some 10-15 times theory, things will kind of settle in. Now we'll move to an area called as mutual funds, which is again predominantly a practical based area. There are few theory based concepts which can be there, but it's predominantly a practical based area. Now let's first understand what are we going to learn in mutual funds chapter, and then I get to an areas what is mutual fund and what is the use of that, all that will come to it. We're going to learn first own return versus MF return. There's a concept you're going to learn called as how much own return should I make, or how much MF should make so that it compensates me for my return. So there's a concept called as own return versus MF return. Then there's a concept called as holding period return versus annual return. I'll talk on all these concepts as we proceed. There's a second concept which is on holding period return versus annual return. There's a third area called as dividend reinvestment, growth, and dividend payout. So there's something called as a dividend reinvestment plan, there's a growth plan, and there's a dividend payout plan. So how does these three plans work? I can also add bonus plan. So how do these plans work is what you're going to learn in one segment of the chapter. We'll also learn how do we compute NAV. This I had done in one of the question in security valuation. I said I'll discuss in detail later on that how do we go ahead and compute the net asset value of the company or net asset value of the mutual fund. So the computation part of that we are going to focus in this chapter, and evaluation of performance. So how do we evaluate the performance of a mutual fund? Has the MF done well or it has not done well? So how is the performance evaluation of a mutual fund is going to be done? This is the broad segmentation of the chapter. Maybe I would have classified this into 3 segments in my material, but these are the important concepts which we are going to learn. So let's first understand what is a mutual fund. See, a mutual fund is basically like a trust. It's going to collect money from like-minded investors. So it's going to collect money from lots of people. Different people have different expectations of return, risk-taking ability. So there are different types of MF which are there. The MF is going to collect money from multiple people. There are set of people who want to take a lot of risk. For them, there are certain aggressive kind of mutual funds. There are set of people who don't want to take risk. For them, there are certain conservative kind of mutual funds. So different people have different ability to take risk. So based on the ability to take risk, I decide on the mutual fund I want to invest in. If you are also having that ability to take risk, you will invest in the same mutual fund. So MF is going to collect money from multiple investors. So I'm going to collect money from a lot of people. There will be an initial fund offer we'll be making called as new fund offer, like we do an IPO. In mutual fund, there's going to be a new fund offer. So an NFO would be there. It would be open for some 10-15 days. Whoever wants to invest in that mutual fund, they'll invest money in that. After this money is collected, I will be regularly collecting more money, or people can redeem the mutual fund also. So regularly also I'll keep collecting money from people, whoever wants to enter into my mutual fund, and whoever wants to exit, they'll take an exit and move. So people can enter at any time, people can exit at any time, unless there's something called as an open-ended fund and closed-ended fund. We'll discuss that later. But you can keep entering and keep moving out of the mutual fund. After this is collected, this is the first step of collecting the money. MF will invest this money as per the terms of the agreement. So there will be a scheme objective which will say, the objective is going to say where am I going to invest. I'll not exactly tell the companies and all. I may say that I want to invest 80% in large cap companies, or 60% in large cap, 20% in small cap, 20% in mid cap. It's not even defined 60, 20, 20. A broad range would be defined, saying that my large cap investments would be so much, small cap investments would be so much, mid cap investments so much, or it could be altogether saying that I am going to invest in debt instruments. There are mutual funds which invest in debt instruments. There are mutual funds which invest only in gold. That's called gold mutual fund. There are instruments which invest only in government security. So different mutual funds have different rules. So they will tell where are they going to invest this money. A broad idea will be given, saying that I am going to invest your money in XYZ thing. After the investment is done, MF will earn or lose. It could be earn or lose money. MF is one place where you can even have negative returns. There is a possibility of negative returns which I can get. So MF will earn something. Whatever MF is earning, a part of it will use for meeting its expenses. A part of it will use for meeting its expenses. And MF will have a team of people who are going to track markets. So there are salaries to be paid to them. There's a need for an infrastructure. So there are rent to be paid. There are cost on systems. So there are multiple expenses which they are going to incur. So MF will incur expenses. There are certain limitations on this by your Association of Mutual Funds of India. So this is technically called as expense ratio. There will be a cap on the expense ratio which an MF can incur. Any increase in expense ratio will technically reduce my returns. If I am investing in the mutual fund, it is going to technically reduce my returns. And unfortunately, if MF is losing money, then also there will be an expense ratio. Then also there is going to be an expense ratio. So expense ratio is going to cut down, the money which is going to come to the end investor. So you have invested in mutual funds. After investing in mutual funds, what technically happens is MF will earn 15%, 18%, 20%, 30%, whatever they can earn. They'll earn that money, meet their expenses, balance will go to the investor. From a practical world point of view, MF computes NAV every day. If market moves up today, you will see the MF value going up immediately by the end of the day. The MF will release the net asset value. It is mostly released by 11 p.m. or 12 p.m. By that time it gets released, the NAV will come, and next day morning you can look at the NAV of the mutual fund. If markets have moved up, your NAVs will start moving up. This is assuming you are an equity mutual fund. If you are an equity mutual fund, every day they will accrue expenses also. Every day they are going to accrue expenses. So NAV would be computed on a daily basis. You can enter at any point of time, you can exit at any point of time. There are certain exit loads which a mutual fund will have. I'll touch upon that as we proceed. So this is what the mutual fund is going to do. The role of a mutual fund is very simple. It is going to collect money from people like you, people like me, and it will invest in multiple instruments as per the scheme document. After making the investment, it is going to earn money or lose money on a daily basis. If let's assume it invests in debt mutual fund, if you're investing in debt mutual fund, they will accrue interest income on a everyday basis. They're going to accrue interest income on daily basis. So there is going to be income or expenditure on a daily basis which is going to be accrued, and then the NAV would be computed. Now MF plays a critical role in the marketplace. I keep saying this, MF is the best instrument to create long-term wealth. This is a belief which I have, and I have been following this belief for a longer period, and I've seen many students of mine also getting into mutual funds at even an young age. So investing in mutual funds is something which is going to help you in creating long-term wealth. If you invest money in fixed deposits, you will earn a return of 4-5% post-tax, or maybe at best 6% kind of a return if taxation is not there. If you are in the exempt category, you may earn around a 6% kind of a return. If you invest in direct equity, you may earn fantastic returns. You may earn fantastic returns. You invest for 1 year, unless you are aware of the market condition, you will invariably end with closer to 0% return. You will invariably end with closer to 0%. Most of the people invest in equities through certain tips which comes from friends, or through certain subscriptions you make. You are not having the ability to analyze the market as of now. You don't have the ability, except for few people. Most of us, I don't even track my investments. I don't have the ability to exactly track all companies, so I don't get into making my own investments. I have put my major chunk of money, my 75 percentage of my corpus is in mutual funds today. Only 15 percentage is in direct equity. That also I've just recently started. I have done in the past direct equities, lost money, gained money, lost money, gained money. In the end, I felt that it is not worth the amount of time I spend on the market. So you may end up earning more than what the mutual fund gives also. I tell you to study 9:15 to 3:15, you'll be tracking the markets. You will see what is happening to the market movement. If you are invested in equities, this is what is going to happen. At this age, what is expected out of you is you study or focus on your articleship commitment. But what students end up doing at this age is they hear from people saying that we can double our money in markets. If that was so easy, then you can even quit your CA. If it is so easy to double the money in the markets, then there is no need to even do your chartered accountancy. Why are you even doing your chartered accountancy if it is so easy? So people have that notion that it is possible for someone to double the money. I am of a strong belief that you should never get into direct equities unless you have the knowledge and the time. It's both very critical. One is knowledge and second is the amount of time which you want to spend. Now then, what role does a mutual fund play? Now listen. You will also understand why it is critical to start early in this example which I'm going to give. Let's assume I'm investing for 20 years. I'm investing for a period of 20 years. My opening balance is zero. I have decided that I'll do investment of 10,000 every month. That's the starting investment. Mutual fund can even start with 1,000 per month. You can even technically start with 1,000 per month. There is no limit. Minimum limit is I think 500 or 1,000. Some funds have 500, some funds have 1,000. If you are doing a systematic investment plan is every month you are investing something. If you are going for a lump sum route, then you'll have to start with 5,000 every time you invest. Mutual fund historically have given a return of 12% per year. This is a minimum return I've seen mutual funds giving. This is a historical return which they have given. My closing balance is opening balance plus investment plus return. Next month, your opening balance is 10,000. You invest again 10,000. You earn 100 rupees on your opening 10,000. The value keeps going on. The value keeps going on. This somebody does for a period of 20 years. He does it for a period of 20 years. Now the value at the end of 20 years is some 98 lakh rupees. The value at the end of 20 years is some 98 lakh rupees, assuming you invest 10,000 per month. That's the starting part. But now I wanted to explain more on why it is critical to start early. One that part, and the second part, whatever I'm going to talk for the next 10-15 minutes, has no linkage to the subject per se. It's maybe something which is very critical, something which you should influence your parents to do, or you should also start. The benefit of starting early is 20 years I invested, 98 lakh I got. Assume I started 1 year early. I got extra 1 year and I invested one more year. Somehow I got extra time and I invested for one more year. Investing for one more year will make this 98 lakh 1 crore 12 lakh, which is basically an increase of some 20, around 12-13% in the corpus 1 year. What you were doing in 20 years, in 1 year you are able to get some 13-14% results. That is because this is called benefit of compounding. If you start early, you'll be in a position to retire at an early age. Assume somebody did not agree to this. I told them that start early. He started 5 years late. Instead of doing 20-year period, he did only 15-year period. 15-year period, if you do, you'll get only 50 lakhs. But if you do 20-year period, you'll get 1 crore. That's the difference which the value is coming out to be. A 15-year period investment will give you 50 lakhs. A 10-year period will give you further lower. It's not that 20 years is 1 crore, so 15 years is 75, 10 years is 50. It will not work that way. It is going to be an exponential fall or an exponential rise which is going to be there. This is one part. The second part is many people invest money in fixed deposit. Fixed deposit will give you 6% per annum, assuming they end up giving you 6%, which is also doubtful at the current scheme of things, considering taxation and all. Mutual funds also has taxation into it, but it's only the LTCG which is taxable, and that is at 10% rate. So 6% if you get, and you invest for 20 years, which is what most of the people do, you'll get only 46 lakh rupees. You'll get only 46 lakh rupees, whereas a mutual fund is going to give you 1 crore rupee. Mutual fund is going to give you, historically it has given 12% return. It's not that it always gives positive return, but historically it has given 12% return. Instead of doing this, many students get that excitement saying that, okay, I'll do trading, I'll do short term investing. That's an excitement which people get. Other than excitement, nothing much is there. I've also got into that excitement trap at some point of time. So you get excited, you do investment, you don't earn any returns, then you come back to the square one, and then you understand, okay, nothing is going to work now. Let me go back to what I was doing. So let me start doing mutual fund SIP. So mutual fund is extremely critical instrument in the practical world for a long-term wealth creation. Now I talked about a 10,000 example. It's not possible maybe for a person to start with 10,000. Assume you start with 5,000. But what is also possible is this SIP amount can keep increasing at steady rate because your incomes keep going up. So there are people who may invest 5,000 and keep increasing at the rate of 10%, keep increasing this investment at the rate of 10% per year. 5,000 becomes 5,500. In your case, let's assume you start at your articleship period. Once your articleship gets over, there could be a huge jump. Assuming clear your chartered accountancy, there could be a huge jump on your SIP amount. It may be even 20,000, 30,000, 40,000, whatever you can afford at that time. But what indirectly happens is as you increase the investments, your returns will keep going up. So in this example, starting with only 5,000, not even 10,000, I end up with 1 crore 6 lakh. I end up with 1 crore 6 lakh, where I was ending up with 97 lakh. Practically, mutual fund is an extremely critical instrument. One, for long-term wealth creation. Second, if at all any of you have an early retirement plan, it's an instrument which will help you in early retirement. I had a passion towards teaching, so I wanted to do full-time teaching. I was managing both teaching as well as my corporate career at some point of time. I quit teaching in the month of May 2020. Sorry, I quit my office in the month of May 2021. Whatever income I was getting from my salaries is got replaced with my mutual fund return. I planned in such a way that whatever I was getting there, technically I created a corpus. Corpus gives me around 1% per month. So whatever was coming in my corporate career, technically that amount my mutual fund is giving. There is only one asset which earns you return even when you are sleeping. That asset is basically invested money. Whatever money you invest, whether you work, you don't work, whether it's a holiday, not a holiday, it is going to give returns. So it's extremely critical that at a young age you start investing, saving money and start investing. Assume you don't earn any returns also. You don't earn any returns. Let's assume you have invested and you don't earn any returns. Still, at least you saved the money. Else, what will happen is, unless you have that saving habit, you will do expenses which are not needed. There are certain expenses which could be avoided just because you have money at your end. You will end up spending money on things which are not even needed. So the important thing which I wanted to say is, as far as mutual funds is concerned, start at an early age whenever it's feasible for you. Start with 1,000 per month, 500 per month, 2,000 per month, 3,000 per month, whatever you can invest. Keep increasing based on your income potential. If income goes up, be ready to increase this amount and start creating long-term wealth. Long-term wealth creation can happen only at this. Increasingly, people, now this is something which is happening increasingly, is that people want to retire at an early age. When I say retirement, does not mean technically you come out of all commitments. Basically, people don't want to do a stressful job. They get into something called as a freelancing kind of a work they will do. they want to follow their passion which gives them some income which can meet their expenses. But in order to do all that, you need some corpus at your end. Unless you have a decent amount of corpus, you will not be in a position to take a call of retiring early. So somewhere have that in mind. I had a plan that I wanted to come out of corporate at the age of 35. I came out at the age of 33. So that was the plan I had when I was very clear. When I cleared my chartered accountancy, I wanted to start teaching. So I started teaching in May 2011. I started my corporate career also in May 2011. Was with a single company for a period of 10 years and then moved out. So when I moved out, I was very clear that I wanted to move out by 35. The corpus got created only because of mutual fund investment, and it gave a lot of shocks in between. When COVID came in, my corpus came down by 30%. So whatever corpus was there, that is what mutual funds will do. When COVID came in, markets crashed big time. I was confident that markets will recover at some point of time, so I invested more money at that stage. So when you invest more money during the low period, you will be able to earn more and more returns. But even after investing for some 7-8 years, I saw negative returns when COVID came in. It became whatever my 7-8 years returns were technique turned out to be negative, but now it's more than 12%. At this stage, it's more than 12% because markets recovered big time after that. So it is critical that you start at an early age and keep investing in mutual funds. Now let's come to the discussion from the subject point of view. I've already told you what mutual fund does. They are going to collect money from a lot of people. They are going to make investments. When a mutual fund make investments, they're going to incur two expenses. One, there is an initial expense ratio. What is initial expense ratio is, whenever I do an IPO, there is going to be initial expenses associated with an IPO. So if a company is doing an IPO of 500 crores, if you look at the terms of the objects of the raising money, one of the object will say share issue expenses. They are going to incur expenses for issuing the shares, which could be broadly 1% of what funds is getting raised. There could be some underwriting commission to be paid. There could be some prospectus related expenses to be paid. Certain compliances have to be done. So one is an initial expense which the mutual fund is going to incur. And the second part is, every year it is going to incur certain expenses. Every year there are expenses going to be incurred by the mutual fund. Now what is the effect of all of this? The question will say that if I invest in mutual fund, I can earn, sorry, if I invest direct equities, I can earn 14%. I can earn 14%. How much should the mutual fund earn so that they give me 14%? How much should the mutual, this is the first part of the question, the first concept, which is their own return versus MF return. The problem is going to say that if you invest directly in mutual fund, you can earn 14, sorry, directly in direct equities, you can earn 14%. Direct 14% can be earned. There is a possibility of earning direct 14% in this. But what will happen is, if you invest in mutual fund also earns 14, then you will get only 12 or 11. You will get only 12 or 11. The reason is expense ratio is there. There are expense ratio. They are going to incur those expense ratio. So it becomes critical. It becomes critical that the mutual fund earns slightly more. So how much should they earn is what you're going to see in the first part. Now, let's assume I invest 100, 14% return. So 14 rupees I can earn. I can earn 14 rupees. Now I want the mutual fund to earn slightly more. Slightly more. Now what that slightly more is going to be? First, the mutual fund says, I get only 98. I don't get 100 from you. You gave me 100, but 2% went in initial expenses. 2% went in initial expenses. So what I got is only 98. What I got is only 98. You gave me 100, everything fine, but it turned out to be 98. So the mutual fund says, I'll have to earn 14 rupees on this 98. I have to give you 14 rupees return. So I'll have to earn 14 rupees on a base of 98. On a base of 98. I cannot earn 14 rupees on a base of 100. 14 on a base of 98. What is the percentage? 14 point. Then the mutual fund also says 14.29 is also not going to help me. I have my own expenses of 2%. I have my own expenses of 2%. So if I earn 16.29%, if I earn 16.29%, I can give you 14% return. I can give you 14% return. The formula is MF return is equal to own return. Own return is how much you want to earn directly, divided by 1 minus initial expense ratio. 1 minus initial expense ratio, that is 100 minus 2% 98, 100 minus 2% 98 plus recurring expense ratio. You also need to take care of the recurring expenses which are going to be there. Page 196, MF return versus individual return. MF return is equal to own return divided by 1 minus initial expense ratio plus annual expense ratio, plus annual expense ratio. Let's come to questions now on this concept. Page 199. Question 1. Question 1. Mr. A can earn a return of 16% by investing in equity shares on his own. Now he is considering a recently announced equity based mutual fund scheme in which the initial expenses are 5.5, annual recurring expenses are 1.5. How much should the fund earn to provide a return of 16%? What is the target expense ratio if the MF can earn 18? What is the initial expense ratio if the MF can earn 19%? Just go through the question. Okay, if I invest on my own, I can earn 16% return. If I go through mutual fund also, I want same 16%. If I go through mutual fund also, I want same 16%. That's the requirement I have. That can come provided he is able to meet those two expenses which are there. Now, right, MF return is equal to MF return is equal to own return divided by 1 minus initial expense ratio plus annual expense ratio, plus annual expense ratio, recurring expense ratio. You can give any name to that. Annual expense ratio or recurring expense ratio. Own return divided by 1 minus IER plus AER, initial expense ratio plus annual expense ratio. How much return you can generate by investing directly? 16. 1 minus, what is the initial expense ratio? What is the annual expense ratio? 16 divided by 94.5%. 1 is 100% basically. 1 is 100%. 16 divided by 94.5%. Divided by 94.5%. 16 point 18 point. So I want the mutual fund to earn 18.43%. I want the mutual fund to earn 18.43%. If it earns 18.43, I will get my 16%. I'll get my 16% only if the MF is earning 18.43. Clear? Any doubts on this? Now MF is saying I can earn only 18%. I can earn only 18%. They're saying what should be the target expense ratio? See, one way is the investor is needing 16. I told please earn some 18.43%. You said it's not possible. If you're earning only 18, either you'll have to reduce your initial expenses or you will have to reduce your annual expense. If one of them cuts down, you'll still be able to earn 16. So they're saying what should be the target expense ratio? What should be the target expense ratio is recurring expense ratio. So same formula, MF return is equal to own return divided by 1 minus IER plus annual expense ratio. Your annual expense ratio will be the balancing figure. MF is 18. 18 is equal to 16.93 plus annual expense. Annual expenses balancing figure are the target expense ratio. How much the target expense? 1 point. If MF can't increase the returns, they should cut down the expenses. If they are able to cut down the expenses, I'll be able to earn my 16%. I'll be able to earn my 16%. So the target expense ratio is 1.07%. Clear? Any doubts on this? Third part saying that initial expense ratio should be what if the MF can earn 19. Now IER is the balancing figure. The initial expense ratio is the balancing figure. 19 is equal to 16 1 minus IER plus 1.5 plus 1.5. 1.5 goes the other side. 17.5 is equal to 16 divided by 1 minus IER. 1 minus initial expense ratio is 16 divided by 17.5. Tell me what is the initial expense ratio. You'll get 0 point something. We'll convert into the numbers, the percentages. 0.0857 are technically 8.57%. Technically, it is 8.57%. 17.5 is equal to 16 divided by 1 minus IER. 16 divided by 1 minus IER. 1 minus IER is equal to 16 divided by 17.5. My initial expense ratio is 8.57%. Any doubts on this? Can you proceed? Clear? Any doubts on this? Two is homework. Go through 3 and complete part 1. I'll take you through part 2. Go through 3, complete part 1. Complete part 1 of the question. Part 2 I'll take you through. Let me know the answer to part 1. 17 point. Okay, it's basically 15 divided by 98%. So 15 divided by 94% plus 2. 15 divided by 94 percentage plus 2. Any doubts on this? Clear? Can you proceed? So part 1 I'm not spending time on that. Now this is where the cons are the point which I was talking about. Mr. X current annual professional income is 40 lakhs. His portfolio value is 50 lakhs and now is spending 10% of his time to manage his portfolio. If he spends this time on profession, his income will go up in same proportion. His income will go up in same proportion. He is thinking to invest his entire portfolio in a multi-cap fund where the NAV will grow at 13% per annum. NAV growth basically means the net return of the mutual fund. Net return means after the expenses. After the expenses. So NAV growth is what I will see. I will not even get to know what the MF is exactly earning, but I can do some calculation. Basic calculation is NAV growth plus the expense ratio. Plus the expense ratio would broadly be equal to the return which the mutual fund is earning. You are requested to advise whether he can invest the portfolio into multi-cap fund. If so, what is the net financial benefit? Now, if I do direct investment, I will earn 15%. I earn 15%. If I invest in mutual fund, I earn how much? No, no, that is part one. In the second, how much the mutual fund will give? 13%. This is after all expenses, okay? 15 and 13 is comparable number. 15 and 13 is the comparable number. NAV growth means after all expenses. So obviously doing direct investment looks fine because 15% I'm earning. But the other angle is when you invest on your own, you have to track markets. You will have to keep track of what is happening in the market. I invest in mutual funds. I don't track anything. Technically, I just review my portfolio once a month. I just do a broad review saying that whether all the funds, even people don't do once a month also, people do once a 6 month or once a year kind of a review. Now I need not spend any time on tracking the market. I'm not really bothered whether market is going up, market is coming down. I'm not tracking anything. This guy was spending 10 percentage of the time to manage his portfolio. So indirectly, 10 percentage of my time gives me 2% extra return. 10 percentage of my time gives me 2% extra. What is the 2 is 15 minus 13. 15 minus 13 on a portfolio of, so extra 10 percentage of my time will give me 1 lakh rupee. 10 percentage of my time will give me 1 lakh rupee. How 1 lakh is? 50 lakh is my investment on that extra 2%. On that extra 2%. Now I need to take a call. Is it worth spending the 10% for that 1 lakh rupee or spend the 10% on my profession and increase that income? Spend the 10% time on my profession and increase the income. So we are this type of a question you cannot answer using that formula route. That is saying that MF return is own return. All that approach will not work because if you do it that way, it is not possible for me to factor this time element. Factoring the time element is not possible. See, if you do trading or if you do investing on your own, you can earn extra return. There is a possibility, but you will have to be extremely skilled for that, and you need to track a lot of things. So for that purpose, you'll have to spend time. Do you have that time or not is a call you will have to take. So here this guy is spending 10 percentage of the time because of his professional income is lower. If he spends that time on his profession, income will go up. Let's do this cost benefit analysis of own investing versus MF investing. Or you can say cost benefit analysis of own investing. I'll write the benefits and cost. Own investing. Particulars calculation amount. Benefits. If I do my own investment, that is, I manage my own money, return on portfolio, how much is my portfolio value? 50 lakhs into 15% I can earn. 50 lakh into 15% I can earn if I do my own investment. Leave some two lines gap. Costs, loss of MF return. Technically opportunity cost. Either you earn 15% or you earn 13%. You cannot have both. So loss of MF return. If you do own investment, you will not earn 13%. So there are two ways of writing this. Okay, I could have even say excess return on portfolio and return only 2%. Directly, I could have written 2% is the excess return. By doing own investment, you don't earn 15. You're earning only extra 2%. You're earning only extra 2% because there is a tool available which could have given you 13%. So a lot of people say that I am investing on my own and I'm earning so much return. No, you're not earning that much return. If you do your investment and earn 12%, let's assume FD would have given you 6, so you're earning only extra 6%. You're earning only extra 6. So this is my loss. I'm basically losing 6 lakh 50 but earning 7 lakh 50. So I'm very happy with this because I'm earning 7 lakh 50 and losing 6 lakh 50. There's one more element to be analyzed. Because you are doing own investing, is there an opportunity cost or an extra benefit for me? What is that? Think. Opportunity cost, because the 10 percentage of the time could have been spent on managing the profession. If you had managed the profession, income would have gone. This I could have done other way around also, saying cost benefit analysis of MF investing, then return on MF, then extra income, and on the cost side we would have said return on portfolio. The loss is the return on portfolio. Now listen, extra income or income lost. Listen for some time. Due to 10% time spent on investing. Income lost due to 10% time spent on investing. Let's assume I have 100 hours with me. I have 100 hours. Just give me a minute. I have 100 hours with me. Today, what I'm doing is 90 hours is for my profession. 90 hours is for my profession. 10 hours is for investing. So 90 hours gave me 40 lakh rupees. 90 hours gave me 40 lakh rupees. Assuming 100 hours are there, 90 hours I'm spending on my profession. I'm spending on my profession. This 90 hours gave me 40 lakh rupees. If you can give extra 10 hours, it will give you extra income. It will give you some extra income. What ICA did is the direct related 40 lakh into 10%, which is wrong. So I'm not following the ICA solution in this question. I'm spending 90 hours of my time and getting 40 lakh. They in the solution said 100% of the time is giving you 40 lakh, 10% how much they did a proportionate calculation, which is technically wrong. 90 hours is giving me 40 lakh rupees. 90 hours is giving me 40 lakh rupees. Extra 10 hours if you spend, you can earn how much? 4 lakh 44,000, 444. Just listen for something. So net benefit of own investing. Net benefit of own investing is negative 3 lakh 44,444. It is negative 3 lakh 44,444. That extra 1 lakh which you are earning by losing 4 lakh 44,000. You are earning extra 1 lakh, but the opportunity cost for that is 4 lakh 44,444 because you are losing that time. You are losing that time. People do not consider this time element whenever they are doing the analysis. So people want to invest on their own. Good, do investment on their own, but you are not even tracking one item called as how much time are you going to spend on that. And if you are spending more time on that, you are technically, so at your age, if you do, you're spending more time on that. Let's assume you started doing market, you spend more time on the market, because of which you could not clear in the first or the second attempt. So that is an opportunity cost, and it's going to be a huge cost in the future. So you will have to see how are you using the time element also, because doing direct investment and all is fine, but direct investing has a time element attached to it, because unless you track the markets, first is time element, second is knowledge, which most of you will not have at this age. I'm making it very clear. Don't try to get into these things where people will tell you some share saying that this is going to go up. Anybody tells a share will go up, ask them a reason, they'll not give a reason. There will not be a reason which is being given by them. 99% will not be able to give a reason. If somebody is able to give you a sound reason, you're able to get clarity saying that this is going to happen, this is the situation, market will behave like this. If they're able to give a reason, then I can understand. But 99% of the people will not have a reason. And that is why market is irrational. You will think market will go down, it will go up. When you think market should go up, it will go down. So all this will keep happening at the marketplace. So in this example, you're understanding the worth of time. The value of time is being factored in here, which indirectly says that earning 2% extra is of no use. Earning 2% extra is of no use. Then when it could have been useful, let's assume my portfolio is 5 crore. My portfolio is 5 crore. And if I need only the same 10% time, because as portfolio value goes up, the time needed to track may also go up. If it was 5 crore, then extra 2% is extra 10 lakh earning. Extra 10 lakh earning. Amount lost is only 4 lakh 44,000. That is fine. That is fine. But for a 50 lakh worth of a portfolio, it is not worth your time. It's not worth your time. At your age, you could be doing some 10,000, 20,000 investment. It may not be worth your time to track the markets. Write this note. I've done the cost benefit analysis of own investing. We can swap this and write MF investing also. The question's requirement is whether he can invest his portfolio in multi-cap funds. What is the answer? Should he invest in MF or no? Yes, no. Yes, so now right. The investor can invest in multi-cap funds. Multi-cap funds. Own investing is not beneficial, and the same will give a net benefit of. They asked how much is the benefit. 3 lakh 44,444. Same will give a net benefit of 3 lakh 44,444. Clear? Any doubts on this? So in this situation, I cannot use the formula based approach. If you use formula based approach and do the calculation, you cannot get an answer. Other situation, the original problem we did, the part 1, if the part 1 says how much MF should earn, you do all that, and they said MF can earn 15%, not the NAV growth, the MF can earn 15% or 16 or 17, some number they give. You had calculated how much you wanted to earn. If the MF earns that much, then I'm okay, else I'll do my own investment. Okay, before I go to the next area, I've taken your feedback. Maybe I'll just discuss 2 3 things. One is on the speed part. I think 20% of you are finding it a little difficult on the speed side. Where also I think specifically when I explain concept, you wanted me to go a little slow. I'll try to go slow, but please keep the feedback open then and there rather than giving me a feedback later on. When I did one chapter like valuation of convertible, one of you had given me a feedback saying that the speed is not manageable. So please give feedback then and there. That later giving feedback, I cannot correct the first 10 classes which have been done. In case you face issues with speed, even during the class, let me know. I'll cut down the speed, or you want me to explain something again. Second, you wanted me to increase the break from 5 minutes to 10 minutes. I'm okay to do it with only one condition. Class will go until 9:15. If you are okay, fine. If some of you have your articleship issues, then I'm not increasing the time from 9 to 9:15, not increasing the break also from 5 minutes to 10 minutes. So you can send me a message if anybody has an issue for 9:15, then break will not get extended. Break will continue to be 5 minutes only. If none of you have an issue with 9:15, I don't have a problem. I'll take till 9:15 and increase your break to 10 minutes. Else, I'll not be in a position to increase the break. In fact, I was not giving a break 2 years back and all. I've started giving a break because people wanted it. But beyond 5 minutes, I can't manage it. So 5 minutes is the max break I'll give. Some of you wanted me to revise the concept by the end of the class. Like I do a revision of the concept by the beginning of the class. Some of you wanted me to revise by end of the class what we have done. I will do that. It may spill over beyond 9. So if somebody 9 or 9:15, whatever time we decide on, if you want to leave in between, you can leave. That's okay. But some people have their articleship, because I'll be doing revision of the concept for 5 minutes, the last 5 minutes. If you can spend time in the class, spend it. I'm not covering it in the base 3 hours. Again, I'm repeating, because certain things I cannot leave, because else I'll have to rush up at few places. So if I can cover those concept related part later on, that is the last 2-3 minutes. It will be extra 2-3 minutes every day. If you can sit in the class, it's okay, because many of days my class gets over at 8:55 or 8:50. Those days it will not matter. You sit till 8:53 or 8:55. But some days I go on till 9 or 9:02 or 9:03. That day it may even further go by 3-4 minutes if I have to revise the concept for the day. I understand that it's a good feedback. I'll try to spend that time as I spend at the beginning of the class. I'll spend end of the class. On the MCQ side, some of you have wanted me to make it more complicated. I don't know. I'm not doing it because already people are struggling with the scores. I've seen your scores, not only this batch, even the past batches have found the questions tougher. Maybe one of you or two of you could have found it easier. It's going to be copy paste of what I've done in the class. I've not done any new questions and all there. So familiarity element will be there, but I'm not complicating it as of now. I'll see what can be done. These were the broad feedback I got. If there's anything else, you can let me know then and there. Speed part is something which I normally keep tracking. I keep asking students. We are going at the same pace that I have done the past batch. I have not increased the pace. I have not reduced the pace. Whatever time I took in the last batch, I completed chapter 1, that the security evaluation, in 10 classes. This batch also it has taken 10 classes only. Not increased, not reduced it. But yes, some concept could have gone little faster. Some concept could have been little slower. So wherever you face an issue, please tell me then and there. Today also when I explain mutual fund, if you want me to explain, because some of you have told me explain some concepts 2 times. I try to do it, but sometimes I feel this concept is very simple and I'll move to the next concept. So wherever you need any extra clarification, please tell it in the class itself. Please tell it in the class itself. I'll try to do a correction that stage rather than doing a correction in the later classes. I'll go to the next concept, which is called MF return. That is, how do you calculate how much return does a mutual fund earn? There are 2 types of mutual fund, or technically 2 types of plans. One is called dividend payout, and second is called dividend reinvestment. There's something called as a dividend payout plan, and there's something called as a dividend reinvestment plan, payout plan and reinvestment plan. This dividend reinvestment slash growth, there are multiple things. Okay, so basically there will be 2 types of question. In one question where dividends will be paid to us, where the dividends would be paid to the investor, and there's a second type of a question where dividends will not be paid. Dividends will not be paid. The mutual fund will declare dividend. You say you don't want dividend, so they will reinvest this money in the corpus and give you some extra units. In the practical world, the units can be in 4 decimals. The units which get allotted to you will be in decimals. The units allotment will happen in decimals. So let's assume I am holding some 100 units and I get a dividend of some 25 rupees. I may be allotted extra 2.5 units or 3.5 units depending on the NAV on that day. You will be allotted units even in decimal. Now, how do I calculate the returns for these 2 types of question is what you're going to learn. First is payout plan. In payout plan is return is equal to what I get back minus what I give is return. This is the base formula. What I get back minus what I give is my return. If I'm getting back 1 lakh rupees and I give 80,000, 20,000 is my return. This is in rupees. Divided by what I give will convert this into percentage. So you gave 80,000, I give you back 1 lakh. Your return is 20,000. Then I say I don't understand 20,000. Then you say 20,000 on a base of 80,000, 25%. I say I don't understand this also. Can you tell me per annum return? So this, what you calculate is called holding period return. Whatever you calculate using this formula is called holding period return. I'll give you the formula, but this is the broad logic. what I get back minus what I give divided by what I give is the holding period return into 12 by m into 100. 12 by m will annualize the return. 12 by m will annualize. For example, you applied this formula, you got 25%. I wanted to know this 25% in how many months. You say you earned this in 6 months. Then your annual return is 25 into 12 by 6, which is 50%. Which is 50%. Your return into 100 to convert into percentages. So 12 by m is going to annualize the return. 12 by m is, sometimes it could be that you say 25% in 3 years. Then I'll do into 12 by 36. Into 12 by 36. This formula technically ignores time value of money. Technically ignores time value of money. So this is not the exact return. To be honest, this is not the exact return of the investor. Time value of money, if you have to consider, then you will have to do IRR. You will have to do IRR. For doing IRR, if it's an exam situation, one outflow, one inflow, you can do IRR. Or sorry, one out, not one outflow, one inflow. There can be multiple outflow, multiple inflow and all. But it should be every year. That is, the cash flow should happen at the end of first year, second year, third. 1 minute. I'll just. Okay. Now this is the formula. What I get back, what I in get back minus what I give divided by what I give into 12 by m into 100. If I want to know the exact return, I should go through IRR technique. I should go through IRR technique. IRR will give me the exact return which I can generate. For doing IRR in Excel, I can do it for any time period. But if you have to do, the cash flow should happen exactly at the end of the year. If it's something in between the year, 5.5 years or 5.4 years, you will not be in a position to do that in the calculator. In exam questions, they don't ask us to compute IRR. IRR computation has not been asked many a times in exam, but IRR is the real return which the MF is going to make. The real return which the MF is going to make is the IRR return. So holding period return, the first part I was talking about, holding period return is what I get back. What you get back is NAV1. What you get back is NAV1. NAV1 means basically the NAV at the end of the year. NAV at the end of the year. On top of that, you may get some dividend income and capital gain distribution. D1 and CG1 is called dividend and capital gain distribution. Now listen, D1, CG1 doesn't make any difference. What is D1 is dividends paid to you out of the dividend income generated by the mutual fund. Dividends paid to the MF investor out of the dividend income generated. CG1 is capital gain distribution, that is dividend paid to you. Dividend paid to you out of the capital gains generated by the MF. Dividend paid to you out of, it's basically again the dividend only. It's basically again the dividend only. Both are dividend only, but we use a different terminology. One is called D1, another one is called CG1. CG1 means dividend paid out of the capital gains. Dividend paid out of the capital gains, and D1 is dividend paid out of the dividend income. Dividend paid out of the dividend income. So dividend paid out of the dividend income is there. Dividend paid out of the capital gains is there. There are two types of distribution. So what you get back is NAV1, D1, CG1. You get three things. NAV1, D1, CG1. What you invest is NAV 0, today's investment. NAV 0. NAV 1 minus NAV 0 is called capital appreciation. NAV 1 minus NAV 0 is called capital appreciation. D1, so my return is capital appreciation plus dividend. Capital appreciation plus dividend divided by what I invest is NAV 0. Divided by what I invest is NAV 0 into 12 by M into 100. So NAV 1 minus NAV 0 plus D1 plus CG1 divided by NAV 0 into 100. This is holding period. If you want to annualize this into 12 by M into 12 by M. Now sometimes the question will say the person is going to reinvest the dividend income. He is going to reinvest the dividend income. If you are reinvesting the dividend income, then exact formula is this. Exact formula is this. What will you do is dividend you will not get. Dividend you will not get. It will be like this. I invested 300 units into 12 rupees. Let's assume you invested 300 units into this. When it is dividend payout, you can calculate even for 1 unit. You can calculate for 1 unit. When it is dividend reinvestment, what is dividend reinvestment is you reinvest the money. You reinvest the money. So 300 into 12 is your investment. This gave you dividend income of 400 rupees. This gave you dividend income of 400 rupees. You told the company, don't give me dividends. Don't give me dividends. So what they did is this 300 became 350. They gave you extra units. They gave you extra units. On the last day, this is 13 rupees. So your return is 350 into 13 minus 300 into 12. 350 into 13 minus 300 into 12. The value will go up. The value will go up. 350 into 13 minus 300 into 12 divided by 300 into 12. This is called holding period return. If you do into 12 by M, it will become annual return. It will become annual return. Clear? Any doubts on this? So, dividend payout versus dividend reinvestment is one frequently tested exam question. So, MF return, holding period return is NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 100. Annual return is NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 12 by M into 100. You will have to do into 12 by M. These notes are certain points which you will keep learning in different question. You will learn this in different question. Dividend payout versus dividend reinvestment. In a dividend payout plan, the investor will get dividend in rupees. In case of dividend reinvestment, the dividend will get reinvested and we will get additional investment. So return for dividend payout plan, whatever formula I gave you, please follow that. Return for dividend reinvestment is closing value minus opening value. Closing value minus opening. What is closing value is 350 units, 400 units, whatever number of units you have into the closing NAV. Opening value is whatever units you had into the opening NAV divided by the investment you made into 100 if you do holding period, into 12 by M into 100 if you do, it will become the annual return. One more thing is whatever dividend an MF pays, again this needs to be applied. This needs to be applied on the face value. The dividend which is paid is applied on the face value of the instrument, like we were doing it in the shares. Like we were doing it in the shares, dividend percentage will be on the face value of the instrument. D1, CG1 does not make any difference to us. Whether it's D1 or whether it is CG1, it doesn't make any difference. Both are technically dividends. Let's come to question 4. The questions are going to be fairly simple here. A mutual fund had a NAV of 20 at the beginning of the month, made income and capital gain distribution of 3.75 paise and 3 paise, ended with an NAV of 20.06. Compute the monthly return. Now, if they ask monthly return or quarterly return or 2 yearly return, 5 yearly return, anything more than a year, its obvious expectation is that you will answer both holding period return and the annual return. Anything more than a year. Anything more than a year, because what is understandable is annual return. Here specific requirement is monthly return. So no into 12 by M. No into 12 by M in our calculation. Let's do. Return is equal to, there's nothing much to explain, NAV1, NAV0, D1, CG1 by NAV0 into 100. NAV1 minus NAV0, D1 CG1 by NAV0 into 100. How much is the ending NAV? NAV1. Opening NAV, D1, CG1. How much the capital gain distribution? Okay, that's okay. Doesn't make any difference. Doesn't make any difference. You can swap the order. Divided by 20 into 100. Zero point percentage per month. This is the per month return. 0.6375 percentage per month. Any doubts on this? 0.6375 percentage per month. Clear? Any doubts? Can you proceed? Now, this is a question on holding period return versus your dividend payout versus dividend reinvestment. A frequently tested question. This has come multiple times, be it exam or be it RTPs, MTPs. Mr. X, an investor, has purchased 300 units of ABC mutual fund at the rate of 12.25 1 year ago. Over the year, he received 1.25 as dividend, capital gain of 1 rupee. Mr. X holding period return, assuming that this no load fund has an NAV of 13. Holding period return, assuming that all dividend and capital gain distribution are reinvested. Part B is reinvestment, which I'll take you through. Part A is normal calculation. Normal calculation, which is NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 100. Holding period means no into 12 by M. No into 12. Complete part 1. When you do normal plan, it does not matter whether I bought 10 units, 200 units, 300 units, 500 units. Nothing matters there. Apply the formula and then get to the answer. The number of units do not matter in the calculation. It will be 13 minus 12.25 plus 1 plus 1.25 divided by 12.25 into 100. And even if they ask the annual return, both are same. This is 1 year investment. Holding period return and annual return is same in this question. How much is the return you said? 24 point. This is for a payout plan. This is for a payout plan. They have used the word no load. No load means there's something called as entry load and exit load. Entry load as such has been removed. Entry load is basically when you buy a mutual fund, you'll have to pay something extra. Exit load is if you exit at 20 rupees, they'll not give you 20, they'll give you 19.5 or 19.75. Exit load still exists. Entry load is not there. Relevance of this you'll understand in one other question. The entry load and exit load relevance. Second part is I'm doing reinvestment. I'm doing reinvestment. This we'll have to do a little detailed calculation, particulars calculation amount. Particulars calculation amount. Point number one, investment made. Investment made. Now I want to know the number of units and all. How many units are there? At what price did we buy? 12 point 300 into 12.25. This 300 will increase to some number now, will increase to some number, because what the mutual fund is doing is, whatever dividend and capital gain it is giving, instead of distributing the dividend and capital gain, it has been reinvesting that. It has been reinvest. So point number 2, dividend per unit. For me, dividend and capital gain, everything is same only. Okay, I'll use the word dividend per unit, which means dividend and capital gain. Dividend and capital gain. How much per unit dividend and capital gain? 2.25. That there's no difference between dividend and capital gain from an analysis point of view. Dividend for 300 units. The mutual fund said, I'll not give you 675 rupees. They earned 675, and the MF is saying, we will not give you 675, we'll give you something else. So the same dividend, I can say dividend in units. The same dividend in rupees can be converted as dividend in units. Instead of giving me rupees, he is going to give me units. He is going to give units. What is the reinvestment rate dimension? 675 divided by 12.5. 675 rupees divided by 12.5. How much? Now, I have not seen exam question testing this, but from a practical world point of view, the 675 will be subject to TDS. There can be some TDS element which will come, because of which the units which will get allotted can be on the lower side. Because 675 is not the income for the person. This dividend will also be, I think, taxable. So this taxability part, they will deduct TDS. I think beyond a limit, there is a set limit which is there. Beyond that limit, TDS will come into picture. Dividend in units is 54. Now, closing value. Closing value. How many units did we buy? How many units we are going to end with? 354 into what is the NAV? Closing NAV. I started with 3675. I'm going to end with 4602. Started with 3675. End with 4602. Starting part is 3675. End with 4602. Nothing in between. Okay. Let's not worry about anything in between. No dividend, nothing you're generating. So return in rupees. Return in rupees is what I get back minus what I invest. What I get back minus what I invest. 4602 minus 3675. Get back minus what I invest. I'll get 927 rupees. I'll get 927 rupees. Holding period return percentage. Whatever we have calculated above is also holding period return only, but that is in rupees. That has been expressed in rupees. Now we'll have to express this in percentage. That is basically 927 on an investment of 3675. On an investment of 3675, 25.22%. The holding period return is 25.22%. That's the HPR we are able to generate. The holding period return is 25.22%. Any doubts till now? Okay. Now some question will ask, which is not a good question, but they'll end up saying that which is better, dividend payout is better or dividend reinvestment is better. That will be one question in the exam. You calculate both the returns, you answer whichever gives higher return, that to be better. But logically, these two are not comparable. This option, the other option is not comparable. Because in the other option, you got dividend of 675. What you could have done is that you could have invested somewhere. We don't know when that money came, what did you do with that money. So indirectly, that extra 675 which you got could increase there also, could increase there. Here, indirectly, the 675 dividend on the last day has become 702 rupees. How 702 is 54 into 13. 54 into 13. The dividend of 675 by the end of the period or the end of the year has become 702. Has become 702, and that is why you are earning extra return. Assume the question says you reinvested 13. You're doing reinvestment at 13, assuming they say that. The number of units will become 300 plus this. Your return is 24.49%. This is what you would have got in the earlier situation also. Earlier situation, when you would have done the calculation, ignore the calculation numbers here for the time being. What I've done is my reinvestment I've taken 13 rupees. Assuming the reinvestment had happened at 13, they have given the reinvestment rate to be 12.5. They have given the reinvestment rate to be 12.5. If the reinvestment had happened at 13 rupees, payout and reinvestment will give the same return. Payout and reinvestment is going to give the same return. Technically speaking, payout and reinvestment cannot be compared. Cannot be compared because in payout you would have got the dividend of 675. You could have done something with that. I don't know what have you done with that. I don't know what have you done with that investment, but you would have used that for some purpose. You would have used that for some purpose. Some investments you would have made out of that, or something would have been done. It can also be that reinvestment happens at 13.5. Reinvestment happens at 13.5. If your reinvestment NAV is more than the closing NAV, reinvestment plan will give lower return. Reinvestment plan will give lower return because you reinvested at 13.5. By the maturity, this has become 13 rupees. By the maturity, it has become 13 rupees. So if you reinvest at 13.5, your return is 23.81%. Your return comes down to 23.81%. If your reinvestment NAV and the closing NAV is same, payout return is equal to reinvestment plan. Payout return and reinvestment plan return is same. Payout return and reinvestment return is same. In case reinvestment NAV, in case reinvestment NAV is equal to closing NAV. Other situation which has happened in this problem, if my reinvestment NAV is lower than the closing NAV, my reinvestment plan is technically giving a higher return. This analysis and all you need not do in exam. The only thing that asks is which is a better plan, calculate the returns and say the company should go ahead with or the investor should go with dividend reinvestment plan or dividend payout plan, whichever is giving a higher return. But logically speaking, both options cannot be compared because your reinvestment would have happened by the mid of the year. I don't know when it has happened. The 675 I would have created an FD. In FD, I will earn extra return. That extra return is not considered in our formula. That extra return is not considered in our formula. Any doubts on this? Any doubts on this question? Let's come to question 6. NAV per unit of XYZ mutual fund, a close-ended fund on 1/1/2014 was rupees 28. Value on 31/12 comes to 28.8. On the same day, the unit was trading in the market at a premium of 3%. On 1/1/2014, it was trading at a discount of 5%. It distributed dividend of 2.8. You are required to compute the rate of return to the investor during the year. I'll first explain what is a close-ended fund. In a close-ended fund, what will happen is the entry is fixed, the exit date is fixed. So you will make an entry into the fund, let's assume on 1/1/2014. It will be an exit after 2 years, 3 years, 4 years, 5 years, depending on the terms. Depending on the terms. In between, if you want to go out of the mutual fund, you cannot tell the MF that I want to go out. So what normally happens is you will give an instruction to the mutual fund saying that I want to go out. Mutual fund will say I'll cancel your units and repay the money. In a close-ended fund, mutual fund will always work with the same amount. What the same amount is? If on day one they collected 100 crores of face value, 100 crores of units were collected, this 100 crore units will continue to remain same. The 100 crore units will continue to remain same. In the other situation, what will happen is every mutual fund, open-ended mutual fund, 100 crore will become 99 lakh units in a day. This is not because of market side movement. This is basically the increase or decrease in unit. 99 lakh will become 1 crore, 1 lakh. It will go down, it will go up, it will keep changing every day. On an everyday basis, it is going to have changes. Close-ended fund, if you want an exit or an entry, then you can do it through by buying it in the market. How will you do it in the buying in the market? Somebody will sell, you will buy. Somebody will buy, you will sell. So depending on if you want to exit out of a close-ended fund, it's like shares. The shares, the number of shares remains same. The company is not increasing the shares, not reducing the shares. If you want to become a shareholder of TCS, you'll have to buy share of TCS from someone else. You'll have to buy share of TCS from someone else. You cannot tell the TCS Limited saying that you please give me shares, I'll give you money, because TCS is not going to allot shares. That is a close-ended fund. That is a close-ended fund. Most of the funds are open-ended, where what will happen is TCS will say, give me money, I'll give you shares. You don't want, you want your money back, return the shares, I'll give you money back, which is not going to happen unless there is a buyback and other things happen. But otherwise, the shares, number of shares remain constant. Close ended fund also, number of units will remain constant. Now our normal formula is NAV1, NAV0, D1, CG1 by NAV0 into 12 by M into 100. 12 by M into 100 if you want to calculate, depending on the annual return. If the question specifically says monthly return, we calculate that. Else, we will do two answers. You will understand as we proceed. Into 12 by M into 100. Now, this NAV1 is not the closing NAV of the fund. The NAV1 is not the closing NAV of the fund. The NAV1 is the closing NAV adjusted for any premium or discount in the market. Adjusted for any premium or discount in the market. The real worth, what is the closing NAV given in the question? If you want to exit or enter, you will not enter or exit at 28.8. You may have to pay slightly more or slightly less. You will have to pay slightly more or slightly less depending on what is happening in the market. Depending on what is happening in the real worth is 28 rupees. But the market is asking you to pay extra 3%. Market is asking you to pay extra. So NAV1 for the formula is 28.8 plus 3%. 28.8 plus 3%. Why plus 3% is, if I want to exit or enter, I'll have to exit or enter at that rate. When I made an entry, it was at 28. This can be 28 plus or minus premium or discount. Plus or minus premium or discount. This premium or discount will depend on the demand of that unit, demand of that mutual fund. If more people are placing a buy order and less people are selling it, indirectly the price will get inflated. Price will get inflated. So here we are going to use the same formula, but NAV1 is not what you see. NAV1 is closing NAV adjusted for premium or discount. Opening NAV is also adjusted for premium or discount. Clear? Any doubts on this? Any doubts on this? Let's start. Return equal to NAV1 minus NAV0 divided by NAV0, 12 by M, sorry, plus D1 CG1, just add that, plus D1 CG1, D1 and CG1, D1 and CG1, closing NAV plus or minus premium or discount, and tell me how much. 29 point. Practical world, NAVs are also 4 decimals. Many NAVs will be in 4 decimals. 29.664. Opening NAV adjusted for premium or discount. 26 point. I think it's 28 minus 5%. 28 minus 5%. D1 is how much? 2 point. CG1. Both okay, both put together. Divided by 26.6 into 12 by 12 into 100. Holding period and annual return is same. HPR or the annual return is same. 29.664 minus 26.6 plus 2.8 divided by 26.6 into 12 by 12 into 100. How much? Clear? Now this is also kind of covered in the concept, so that is what I had kept on saying, that if you just revise this, this is sufficient. Opening and closing NAV will have to be adjusted for premium or discount in case of close-ended fund, This is because NAV can quote at premium or discount to the normal NAV. Premium or discount to the normal NAV. This concept was tested in this question. So next to this, you can write the question number. This is what I had told you to do. Next to the concept, please keep writing the question number so that when you do your revision, it will be useful. Every line which is there in the base theory will have some or the other concept getting explained. We'll take a break of 5 minutes and then continue. Okay, let's resume now. Let's resume. I'll go to the next concept which is there, which is on an area called as growth plan, bonus plan, and a dividend reinvestment plan. There are three types of plans, technically four types of plans which are there: growth, bonus, payout, and reinvestment. Payout will not be tested in exam question. Reinvestment, growth, and bonus are what gets tested. Now, what happens is I invested in mutual fund today. I'm going to redeem this money after some few years. In a growth plan, the number of units do not change. In a growth plan, the number of units do not change. So it's a very simple calculation, a growth plan. Closing value is equal to whatever units you purchased. Let's assume 5,000. 5,000 into the closing NAV minus 5,000 into the opening NAV is the return which you are generating. In a bonus plan, the units will keep changing as and when a bonus is allotted. The units will keep changing as and when bonus is allotted by the organization. Also, for the same mutual fund, practical world, they'll give you 3-4 different NAV. One NAV will be for a growth plan, another NAV will be for a bonus plan, another NAV will be for a payout plan, another NAV will be for a reinvestment plan. Different NAVs would be given for different plan. The money and all is pulled together, same investments happen, everything. The only thing is, in a bonus plan, suddenly units will double because they have done 1:1. If the same NAV continues for a person whose units do not double, and for a person it doubles, then it will lead to variation in return. So final return, whether it is bonus plan, whether it is a payout plan, whether it's a reinvestment plan, whether it's a growth plan, should be more or less closer. It can have some variation. Why will it have variation? Is it depends on the date in which reinvestment happens. For example, if on the reinvestment date, if NAV was very high, then the number of units allotted will be on the lower side. Number of units allotted can be on the lower side. Otherwise, all the three plan will more or less give you same return. Will more or less give same return. Now let's see this in this question. It's a very lengthy question. Sun Moon Mutual Fund sponsored open-ended equity-oriented scheme, Chanakya Opportunity Fund. Three plans: dividend reinvestment plan, bonus plan, and growth plan. At the time of IPO on 1/4/1999, Mr. Anand, Mr. Bachchan, and Mrs. Charu, three investors invested 1 lakh, chosen B, C, and A plan respectively. History is as under, with various NAVs, dividend percentage, and bonus ratio. On 31st July 2009, all three investors redeemed their units. Calculate the annual rate of return. Consider LTCG is exempt from income tax. STCG is subject to 10% income tax. STT 0.2% only on sale or redemption. Ignore education cess. Go through the question. Okay. As of now, I'll continue with the question in the way it is given. Later on, I'll do one rework for only one plan where we'll say LTCG above 1 lakh is taxable, because that's the current situation. Is exempt becomes very simple to do the calculation. So we'll change the scenario saying LTCG above 1 lakh will become taxable. I'll do for one situation alone. because for doing for all the situation will take away a lot of time. So one is the taxation angle. I invested on 1499. I invested on 1499. 1 lakh is what I invested during the initial public offer. So the IPO we technically called as NFO, new fund offer, will happen at the face value of 10. Will happen at the face value of 10. So I purchased 10,000 units. Whoever invested in growth plan, that's the easiest to calculate because it's 10,000 units into 10 is investment. 10,000 into 82.07 is maturity. 10,000 into 82.07. Plan C is the growth plan. Plan C is the growth plan, nothing much. So 10,000 into 82.07, you can subtract certain expenses like your securities transaction tax that you subtracted. There is no capital gain also because it will be LTCG. It is going to be LTCG, and you can easily calculate the return of the person who has invested in the growth plan. That is easy to do. Whoever does in reinvestment plan or bonus plan, you will have to first calculate what is their maturity units. What is the maturity units? Because units will keep changing. Units will keep changing. Working note 1, computation of return of Mr. Anand. Computation of return of Mr. Anand. Return of Mr. Anand. Read the question and tell me what plan he has put the money in. Okay, bonus plan. Mr. Anand in bracket bonus plan. Note 1, computation of units on maturity. Computation of units on maturity. Computation of units on maturity. Date. I think I may need some 5-6 columns. Bonus ratio. Opening balance. Addition. Closing balance. Yeah. Date, bonus ratio, opening balance, addition and closing balance. When did we make the investment? First investment? April 99. 1499. On this day, bonus ratio and all will not be applicable. I did not have any opening balance. I would have got allotted some units now. I would have got allotted some units. 1 lakh divided by 10. Everyone will get the same 10,000 units on day 1. Everyone will get same 10,000 units on the first day. Opening balance 0, addition 10,000. Addition 10,000, closing balance is 10,000. Look at the table, when is the bonus allotted? 28/7 bonus is not allotted. The only dividend is that 31/3, 31st March 2004. 31st March 2004. What is the bonus ratio? My opening balance is 10,000. Addition is 10,000 into 5 by 4. 10,000 into 5 by 4. 10,000 into 5 by 4. Closing is 22,500. Closing is 22,500. The next date is 31st March 2008. What's the ratio then? 1:3. Opening balance is 22,500. Opening balance is 22,500. We allot 1 by 3. Allotment is in the ratio of 1:3. It becomes 30,000. It will become 30,000. Clear? What's the next date? 24 March 2009. Ratio 30,000 is the opening balance. We are going to be allotted 7,000 500. Closing is 37,500. Closing is 37,500. I think that was the last bonus allotment. That was the last bonus allotment. We have got 37,500 units. We have ended up getting 37,500 units. Any doubts on this? Any doubts on 37,500? Now, note to computation of return. Computation of return. Plus calculation amount. Particulars calculation amount. On the last day, whichever date, that 31st July, I am going to come out of it. Sale value of 37,500 units. Sale value of 37,500 units. For plan bonus plan, what is the NAV? 22.98. This much I'll get. 37,500 into 22.98. 8,61,750. Any doubts on this? Less securities transaction tax, less STT. What's the STT rate given? Point 17, rounded off to 24. Less STT 1724. I'll have to pay securities transaction tax of 1724. Clear? Less STCG, less STCG tax. LTCG is exempt. STCG I'll have to check. STCG part I'll have to check. Any allotment of units in the last 1 year from the date of redemption, 31st July 2009, any units got allotted in the last 1 year, 24/3/2009, 24/3/2009. Now, for bonus, there is one debatable issue. What is the cost of acquisition? So I'm not very sure. You can look at the tax side and then clarify later on to me as well. But ICI sometimes take cost of acquisition as zero. Cost of acquisition is zero. Sometimes they say cost of acquisition will be the NAV on the date of allotment. Will be the NAV on the date of allotment. I'm not very sure on this. I think there is some time period they have defined in the Income Tax Act. Before that time period, cost of acquisition is zero. After that time period, something is there. So you can check and then clarify to me in the next class. I'm not getting into your income tax side, but I'm going to take cost of acquisition as zero. This is what I've seen in many question ICI doing. So I'll take the cost of acquisition as zero. But I'm repeating, there was one student who wrote zero. ICI deducted marks for that also. They deducted marks and they say cost of acquisition because in that suggested answer it was something else. So just check. There is some time period. There is some time period. Units allotted before that time period has a different cost of acquisition. After that time period has a different cost of acquisition. If you are aware now, you can clarify. Anybody has any idea on cost of acquisition for bonus units from your income tax side, capital gains chapter? If you are aware, let clarify it. Else, you will have to check and let me know in the next class because I have no idea on the taxation side. So coming to this, we are going to take the cost of acquisition as zero. 7,500 into 22.98. STT is not allowed as a tax deductible expense. STT is not allowed as an expenditure. 7,500 into 22.98 into 10% tax. In question talked about 10% taxation. Yeah. There is no cost. There is no cost. So cost is zero. Cost is zero. 7,500 into 22.98 is the capital gain. Into 22.98 is the capital gain. Into 10% is the taxation. This answer can change significantly if you take the cost of acquisition to be the value on that NAV date. That allotment happens of 19 rupees. So I can say that the capital gain is the difference between the 23 and that 19 rupees. You will get a different answer. Any doubts on STCG tax? Clear? Can you proceed? Net amount received. Net amount received. I'll get back this amount. I'll get back 8 lakh 42 post meeting STT and post meeting the securities transaction tax as well as the STCG tax. Post meeting these two items, you are going to get a value of 842 791. Any doubts on this? Any doubts on this figure? Clear? Less amount invested. How much did we invest? Holding period return in rupees. What is return is what you get back minus what you invest. What you get back minus what you invest. The formula is very logical. There's nothing for you to remember and all. It's a very logical area. What I get back minus what I invest is my holding period return in rupees. 742 791. 742 791 is my holding period return. Is my holding period return in rupees. Holding period return in percentage. Percentage means you'll have to divide by the amount invested. You'll have to divide by the, I'm not bringing the time value, I'm not bringing the annual return as of now. I'll come to that in some time. 742 791. What is the investment we made? Into 100 to express in percentage. %742.79%. 742.79%. This will not really help because in a practical somebody says I got I'll say I got 10x return. My investment was 1 lakh, I got 10 lakh. Then I ask in how many years? If you say 25 years and 10x is not good. 25 years if you're taking and making it 10 times, it's not a good return. So nobody understands what is holding period return. Holding period return is not a comparable or an understandable return. Because the next question which will come is if you say holding period is so much, I'll ask what is your holding period? What is your holding period? Calculate and tell me how much is the holding period? How many months of holding? Months of holding. Number of months of holding. Calculate and tell me the number of months. It's not in years, so that's why I'm doing it in months. From 1499 till the maturity date 31st July, tell me the number of months. 1, I think we start on 1499. 31,399 is 10 years. 31,399 is 10 years. Then April, May, June and July. So 124 months. 124 months. Annual rate of return. Whatever you got as HPR, you can do into 12 by M. You can do into 12 by M. Or the logical one is 124 months is equal to 742.79. 12 months is equal to question mark. 124 months is 742%. 12 months is question mark. 12 months is question mark. Into 12 by 124. 71.88%. Any doubts on this? Now this 71.88 is a misleading number, but in exam this is what you need to do. This is what you need to do. If I want to know the real return, I calculate IRR. If I tell you to do IRR, I'll say year 0. Investment is 1 lakh. 124 months is 10.33 years. 10.33 years. You get back 8 lakh 42. In Excel, you will not be in a position to calculate IRR. 10.33 months, you cannot calculate in Excel. You will find it difficult to do the calculation in Excel in your calculator. In calculator, you cannot do 10.33 years because you invest. If it's 10 years, then they can ask you to calculate IRR. They can ask you to calculate IRR also. Because 10 years, what do you need to do? Year 0, negative 1 lakh. Year 10, 842 791. Start with an initial guess rate, positive NPV, negative NPV, increase the rate, reduce rate, one positive, one negative, and finally you can come to the IRR. Now what is IRR in this case is, 1 power 10.333. You will not be in a position to do this in your calculator. It is basically, just give me a minute, 842. It's basically 23%. This return is only 23%. The actual return which is getting generated is 23%. What is 71% saying is, on base 1 lakh you earn 70%, 71% the first year. Second year also 71% on the base 1 lakh. On the base 1 lakh. Third year also 71% on the base 1 lakh. Fourth year also on the base 1 lakh. So every time you are doing the calculation on the base 1 lakh. Whereas what should ideally happen is, first year you will earn 23% on 1 lakh. Next year you will earn 23% on 1 lakh 23,000. 1 lakh 23,000. Next year it will be 23% on 1 lakh 50 or whatever that number. You keep adding by 23% every year. You keep adding by 23%. This 71.88 is like simple interest. It's like simple interest concept. Time value of money kind of got ignored in this. Time value of money kind of got ignored in this. 23% is compound interest. 23% is compound interest. You will not be required to present this 23% in exam. If the question specifically asks IRR, I think the next question which I am going to do, or I'll leave it as homework. I've done IRR also. That question also did not ask IRR. That question also did not ask IRR. If problem specifically asks you IRR, then you may have to do IRR, but that is only possible if the number of years is in whole number. If the number of years is in whole number, else you will not be in a position to do it. You will not be in a position to do. Assume you still want to do IRR, then you will have to do month, cash flow, period, DCF, and it's going to be month 0, month 124. You can calculate the factor for month 124, but it's going to be a very difficult exercise because you'll have to do 1 divided by 1.0 to 124 times in the calculator. So they're not going to get into calculating that. Still possible for you to do in calculator if you do month 0 and month 124 for the calculation. Month 0 and month 124. If at all they want you to do IRR, then they'll have to give you some factors in the question, because I cannot calculate 124 month factor. I cannot calculate the factor for the 124th month, and even if I calculate, because of rounding off, the number will be very insignificant. The number will turn out to be an insignificant number. Any doubts on this? Clear? Can we proceed? Let's do the next person return. Working note to computation of return of Mr. Bachchan. Computation of return of Mr. Bachchan. Tell me which plan he is investing in. Growth plan. Simplest of the lot. Growth plan is the simplest of the lot. You can fill this. It will start with sale value of 10,000 units. See if any STCG, LTCG and all, that your wish. But this is the format. Get me the answer. It will start with 10,000 units. Growth plan is the easiest. No changes in the number of units. No changes in the number of units. Start with 10,000 and keep doing the calculation. It will be 10,000 units, no changes in the number of units. See if any STCG is applicable. LTCG is not there in the question. It's exempt. The NAV will be different for different plans. So take the respective NAV and then do the calculation. Format is simple. I don't see any STCG tax being there because the date of allotment is 10 years back. There is no new units allotted here. No new units got allotted. $10,000 units into 82.07. Let me know if there are any doubts here. 10,000 into 82.07 STT, no STCG tax, net amount received, amount invested, maturity value was 8,19,059, holding period return 7,19,059, 719 percentage or 69.59, 69.59%. Let me know if there are doubts here. Any doubts on this calculation, please let me know. No dividends. Growth plan doesn't give dividend. So ideally, see, I also manage. So I work in a place where we manage funds of people also. So there, what we do is we always invest in growth plan only, because growth plan is basically you don't need any regular income. When you don't need any regular income, people will invest in growth plan. When you need some regular income to meet your expenses, then only dividend plan will come into picture. And this dividend reinvestment is of no use at all. In a practical world, dividend reinvestment is of no use. If you don't want dividend, then go with growth plan. What is dividend reinvestment is? Units will be allotted and get reinvested. Units will be allotted and get reinvested. So you may solve problems on dividend reinvestment in the class, but what is the point of doing dividend reinvestment when if I don't need the dividends, the best thing I can do is go for a growth plan. Go for a growth plan. If I need dividends, then I'll have to get the dividends allotted and get it paid out. Clear? Any doubts on this? Growth plan, no major calculation. It's going to be a fairly simple computation as far as growth plan is concerned. Can we proceed to the last one, which is again a time consuming area? Any doubts on this? Next, working note 3, computation of return of Mrs. Charu. Note 1, computation of units on maturity. Units on maturity. I may need some 7-8 columns, so manage accordingly. Date, dividend rate, dividend rate, dividend in rupees, date, dividend rate, opening balance. These are the columns as of now. Date, dividend rate, opening balance, dividend in rupees, dividend in rupees, reinvestment NAV, reinvestment NAV, dividend in units. I'll explain this. Closing balance. First, you write the format. Date, dividend rate, opening balance, dividend in rupees, reinvestment NAV, dividend in units, and closing NAV. for a bonus plan and a dividend. In fact, bonus plan, I did that table. You need not even do a long table also. I could have short written like this also. We started with 10,000, 10,000 plus 5 by 4, then plus 1 by 3 of this number, 1 by 4 of this number. You can even present it like that also. Growth, your bonus plan can be faster also. The calculation need not be this detailed. But dividend plan, you don't have a choice. You will have to do this detailed calculation, else you will make a mistake. What is the first day of allotment? Allotment date 1499, not applicable. No opening balance, no dividend, no reinvestment NAV, no dividend in units. You ended with 10,000. You ended with a balance of 10,000. This is the first date on which the allotment happened. The first date on which the allotment happened. 10,000 units you got. What is the first dividend date? 28 July 2003. What's the dividend rate? 20%. Dividend rate is 20%. I had an opening balance of 10,000. I had an opening balance of 10,000 units. Opening balance of 10,000. Now I'll be paid dividend like this: 10,000 into face value. Into face value. What is the face value? 10 into 20%. 10,000 into 10 into 20%. 10,000 into 10 into 20%. This is the dividend I am going to get on 28th July. 10,000 into 10 into 20%. Now I told them I don't need this money. I told them I don't need this money. They said we will reinvest on that date NAV. What is the NAV of this plan, dividend plan on 28/7? 30.70. Reinvestment NAV 30.70. 30.70. So because I did this reinvestment at 30.70, what is going to happen now is they are saying we will give you 20,000 divided by 30.70, extra 651 units. Will give you 651.47 units. We normally work with two decimals. You can even increase the number of decimals also for units. 651.47 units. I am going to get 651.47 units. And my units from 10,000 will go up to 10,651. 10,000 will increase to 10,651.47 because of reinvestment. Because of reinvestment, 10,000 will become 10,651.47. Any doubts on this? Clear? What's the next date on which any dividend payout happens? 31st March. What's the dividend rate? 70%. 70%. I'll have to keep repeating this calculation. My opening balance is now 10,651.47. Opening balance is 10,651.47. 10,651.47. Dividend is this into 10 rupees into 70%. Into 10 rupees into 70%. Yeah, 74,560.29 into 10 rupees into 70%. On this day, what is the NAV? 50.42. And I'm going to get 1,276 units. 1,276.28 units. The cycle will keep getting repeated till you get the last dividend. So please keep repeating this. 1,276.28 will get allotted. 74,560 divided by 58.42. Divided by 58.42. My units increase now. Keep repeating this. Keep repeating this. You can refer the screen if you get doubt anywhere. Else keep repeating this calculation. Keep doing the computation. It will take some time for you. Keep doing the calculation. The units will keep increasing. It is a time consuming calculation, but once you get a grip of 1 2 computation, balance is formality. Balance is just a formality. Let me know if there are any doubts anywhere. Do this calculation, get to the closing balance. 14,906.16. 14906.16. Everyone done? Anyone still doing? I'll wait. Anybody still doing the calculation? Please let me know. I'll wait. Okay, I proceed ahead then. Now, return computation is the same format. Computation of return. Computation of return. Just give me 1 minute. For STC, you are going to do the entire calculation. When you do STCG tax, any units allotted in the last 1 year, the cost of acquisition will be the NAV on that date. For a dividend reinvestment plan, the cost of acquisition, if at all anything got allotted in the last 1 year, the capital gain will be closing NAV minus the NAV on that date, minus the NAV on that date. On that, you apply 10% and pay tax. 10% and pay tax. Start doing it. Any units allotted in the last 1 year, the cost of acquisition is the NAV on that date. The return computation part is more of a formality. The only thing you'll have to take care is the STCG tax part. The cost of acquisition for units allotted in the last 1 year is the NAV on the date of allotment. There is one allotment which has happened in the last 1 year, 24/3/2009 allotment. Cost is 48, selling price is 53. Difference is capital gain into the number of units into 10%. 53.75 is the selling price, 48.10 is the cost price. 53.48.10 into the number of units into 10%. Any doubts? If not clear, please let me know. For any confusion, please let me know. Yeah, NAV on the date of reinvestment, or technically reinvestment NAV. Technically, the reinvestment NAV. For a dividend reinvestment plan, the cost is NAV on the date of reinvestment. Reason for that is very simple. Whatever dividend you are getting, you reinvested at that rate, so that is your cost. The dividend income which you generated, no, that could be subject to taxation under Income Tax Act. So what will happen practically is, now because dividends are taxable, you'll have to pay tax on this 20,000. So you will get nothing. You will get nothing. You'll have to pay tax on this 20,000. You have to pay tax on 74,560. You have to pay tax on 47,711. You have to pay tax on 32,647. You have to pay tax on 55,046. Every year you will have to pay tax. In fact, the dividend in rupees, when they do reinvestment, they will not reinvest the whole amount, because there's also TDS provision. There's also TDS provision which comes into picture. So finally, what will get reinvested can be slightly lesser also, because of the provision of Income Tax Act. Some of you look a little confused with this 53.75 minus 48.1. Is there a confusion? Please let me know. Sorry? Amount is there an error in the calculation? I didn't understand your doubt, sorry. See, the capital gain per unit is 53.75 minus 48.10. That's the capital gain per unit. Capital gain per unit is this much into number of units you got 1144 point into 10%. The STCG tax is 10%. This is the detailed calculation. Profit per unit is 5.65. Earlier, the profit per unit was entire 22.98 when I did a bonus plan, because I said cost of acquisition is 0. Cost of acquisition was 0. So we took it as entire amount. Any doubts on this? I don't know, some of you look a little confused, so I'm still not getting that grip. So, or I'm not very sure if there's something different here or some confusion. Anybody has a confusion? If you want me to explain again, please let me know. Any doubts on 647? Balance things is formality, that's nothing there. You get net amount of 798, amount invested, holding period return, percentage, and final return is 67.64. Any doubts on this? Can I proceed? Okay, now exam situation, if they want to complicate things, they may make LTCG also taxable. They may make LTCG also taxable. If LTCG becomes taxable, it's going to be a huge calculation which you need to do. Now listen, assume they say LTCG is taxable. Assume they say LTCG is taxable without indexation benefit. There's no indexation part coming in. If indexation and all they'll not bring in, then it will become more of a tax paper rather than your SFM. So in SFM, it's going to be without indexation. In case they bring in a concept of LTCG taxability, then now listen. My capital gain for this 10,000 units is 53.75 minus 10. The first 10,000 units, this is the capital gain. This is the capital gain, 53.75 minus 10. For the next units is 651 into 53.75 minus 30.7 minus 30.7. Next one is 53.75 minus 58.42 loss. There is a capital loss. There is a capital loss. Next one is 53.75 minus 42.18. Next one is 53.75 minus 46.45. And this was the STCG portion. The last one was the STCG portion. Every allotment you may have to calculate capital gain. Every allotment you may have to calculate capital gain. And if it exceeds limit, if they give a limit, then beyond that limit you will have to pay tax. Beyond that limit you will have to pay tax. I'm just telling you the calculation. Calculation is fairly simple. Your selling price minus the cost price. Selling price minus the cost price. Cost price for a bonus plan is 0. Cost price for a dividend reinvestment plan is NAV on the date of reinvestment. NAV. If I had to do this for a bonus plan, these 10,000 units into what was the closing NAV? I think 22.98 minus 10 rupees. For the first 10,000 alone, the cost will be 10 rupees. The cost will be 10 rupees because you paid 10 rupees. That was not bonus units. That was not bonus units. Balance part into 22.98 into 22.98 into 22.98. Everything will have into 22.98. All those units will do into 22.98. Anything less than a year, pay 10% STCG tax. More than a year, whatever the question tells you. Whatever the question tells you. Any doubts on this? Somewhere, I don't know, I'm not getting that comfort. So now, till now, I've not faced that situation in any of the area. This area, I don't know, I'm not getting that comfort. If there is a confusion, let me know, I'll clarify. Clear? Can we proceed? Okay. Eight is homework. The last line of the question said, what is the effective yield per annum? Just one thing I want to discuss. It's a homework question. Effective yield per annum in respect of the above plans. Effective yield is what we have calculated, like that you can calculate. The term effective yield can also be interpreted as IRR. The term effective yield can also be interpreted as IRR. In this question, IRR was possible. In this question, IRR was possible. I have shown the answer of IRR also. I've shown IRR calculation also. In exam, unless the question specifically tells you IRR, you need not get into IRR computation. Unless the question, this question I've shown you both, because I think my investment happened on 1/4/2005. Maturity is 31 3 2010, which is exactly I think some 5 or 6 years. It was an exact time period. So I was in a position to calculate IRR. We are in a position to calculate IRR. So you see here year 0, year 5 inflow, and we calculate IRR. We can calculate IRR in case the number of years is exact whole number. If it's some other thing, you cannot calculate. You will not be in a position to do it. Go through 9. This was a reverse working question. Go through 9. Okay. Some investment has been made on a dividend plan and a bonus plan. The term dividend plan in this question will be interpreted as dividend reinvestment. If it's a dividend payout, then there is no calculation to be done because dividend payout units on day one and units on the last day is going to remain same. So there's no calculation itself to be done. The question mark is that 1 4 2015 price they wanted. What is the NAV on the opening date? Investment is 9,20,000. Average profit means average profit per year. Average profit per year. Average yield percentage is average yield per year. Average yield, one is given in percentage, other one has been given in rupee. You are required to calculate the issue price of both the scheme as on 1 4 2015. The issue price as on 1 4 2015. Now listen. If I come to dividend plan, which is slightly more time consuming and the complicated part, my investment is 9 lakh 20. My investment is 9 lakh 20. My maturity value is 9 lakh 20 plus profit. My maturity value is 9 lakh 20 plus profit. No taxation side, no other issues are there in the question. If you get maturity value and you divide by 49, you divide by 49, you get the closing units. You divide by 49, you get the closing units. From closing units, you will have to keep reverse working and come to the opening units. From closing units, you will have to keep reverse working and come to the opening units. Once you come to the opening units, 9 lakh 20 by the opening units is the NAV. 9 lakh 20 divided by the opening units is the NAV. If you say it's a dividend payout, if you say dividend payout, closing units is equal to opening units, problem is over, that's all. Closing units is equal to opening units, no calculation to be done. I don't need any calculation to be done. So the dividend plan will be interpreted as dividend reinvestment plan. Clear? Any doubts on this? Let's start. Working note 1, analysis of dividend plan. Analysis of dividend plan. Note 1, computation of maturity value. Computation of maturity value. I'm going to use this format with certain changes. Okay, changes is I will not have STT, I'll not have STCG tax. So sale value of whatever units, listen for some time, then you can write. First item is sale value less amount invested will give you holding period in rupees. Percentage also not needed for the dividend plan. They've given only rupee value. They've given only rupee value. Other items are not needed. There is no securities transaction tax. There is no STCG. There is no requirement of doing the percentages and all in this question. So write these three items: sale value, less amount invested, holding period in rupees, holding period return in rupees. No concept of securities transaction tax or STCG in this question. What's the amount invested given in the question? 9 lakh 20. What is the average profit given in the question? 27 748.6 is for 1 year. If they had used the word only profit, then I could have taken it for the entire period. Average means for a year. Average means for a year. How many years is the investment? 5 years. So 27 748.6 into 5 years. I'm not getting into the percentage part. I'm not getting into the percentage part in this question. 27 748.6 into 5 into 5 years. Sale value is balancing figure. 1058 743. 1058 743. Any doubts on this? Any doubts on this calculation? What is the closing NAV given in the question? So tell me XX into 49. Something multiplied with 49 is 1058 743. What is that number of units? Something multiplied with 49. 21 607, exact number. 21 607 into 49. 21 607 into 49 is this number. Some units into 49 is the maturity value. No STT, no STCG tax, none of them are there in the question. You can write below this. Units on maturity is equal to 1058 743 divided by 49. 21 607 units. Any doubts on this? Clear? Can you proceed? Now going to come the little difficult part of the calculation. You listen for some time and then I'll give you time to write. Listen for some time. Note 2, computation of opening units. Computation of opening units. I'm going to do in a reverse working manner. Tell me the first date on which the allotment happened. 1/4. Okay. Next date of dividend. Dividend dates alone. 31/3/2017. Next. Next. Anything else? Okay. 3 dates of dividends are there. 3 dates of dividends are there. Tell me the dividend percentages. 12, 10 and I've written the dividend percentages. I don't know the opening balance. What are the NAVs on these dates? That is given in the question. 48, 50 and these are the NAVs given in the question. Now one thing I know is 21 607. One thing I know is 21 607 is the closing balance. Understand the calculation. It's going to be a little complicated computation. Listen for some time and then you'll end up writing this 21 607. Now for first I'll have to analyze the last. I'll have to analyze the last date, then come to the prior date, then come to the prior date. That's the reverse working. Opening balance on this date is A. Opening balance on this date is A. I don't know the number of units. It is A. Dividend is A into face value given in the question. And let's take it as 10 into 15 percentage. 10 into 15 percentage. You will not be writing it, but I'm showing it to you. This is A. The opening balance is A. This is A into 10 into 15. A into 10 into 15 percentage. 15 percentage 1.5 A. 1.5 A. You are going to write this in some time. Okay. The opening balance is A. Dividend in rupees is 1.5 A. Dividend in rupees is dividend in units is 1.5 A. What is the NAV on that date? 1.5 A by 45. This plus this is 21 607. This plus 1.5 A by 45 is 21607. You will write it in sometime. Listen. So I've written this. This is 1.5a by 45. 1.a by 45. Opening plus dividend in units is closing. Opening plus dividend in units is closing balance. So it's like this. A plus 1.5a by 45 is equal to 21607. Solve this and let me know what is a. Solve this and let me know what is a. 20,000 910. 20,000 910. I cannot write a in the main table because then again I'll have to create another table. It will get a little complicated. So this part you will have to do as a separate note. You'll have to do as a separate note. Let me just complete this. This is 20910. This is for your validation purpose. 20910. This is into 10 into 15%, into 10 into 15%. Units is this divided by 45. 2910 plus 697 is 21607. 2910 plus 697 is 21607. So you will create this table. As of now, the table will be like this. It will be a blank table. First create this table. Write this table. Create the table. It will be a blank table on opening balance, dividend in rupees, dividend in units. Create a table with blank values. Blank values will be there. This also is not there. We are trying to calculate some of the missing data. The missing data is what we are trying to calculate. Missing information needs to be computed. Any doubts on this table? Clear? Now below that, note 1, analysis of 31st March 31/3/2019. Analysis of 31/3/2019. Opening units equal to A in bracket assumed. Opening units is A in bracket assumed. Dividend in rupees is equal to A into 15% into 10 rupees. Face value is assumed as 10. Okay, face value we normally take it as 10. A into 15% into 10. A into 15% into 10. That's the assumption. We get 1.5A. 1.5A. Dividend in units 1.5A. What is the NAV on the date? 1.5A by 45. 1.5A divided by 45. Clear? Opening plus dividend in units is equal to closing. Opening plus dividend in units is equal to closing units. Opening plus dividend in units is closing units. Opening, our assumption is A. Dividend in units is 1.5A by 45 is equal to 21,000. How much is it? 607. You'll solve and get the answer to E. What was the answer you said? 20,000. Answer to A is 20,900. 9? Okay, 910, sorry. 20910. Any doubts on this? Clear? Can you proceed? Earlier we had the units, we were calculating the maturity units. This is reverse working. This is reverse working. So I go back to the table. Opening balance, right, 20910. Technically, even if I don't fill the table also, it is fine, but table will make it little easier and systematic to do. 20910 into 15% into 10 rupees, 697 units. Even if you don't do the table also, it's technically fine. See, whatever I've written note analysis, that alone is also sufficient. This table is not needed. This table was just done so that you are able to visualize the transaction fully. This alone is also sufficient because this will give you the units on opening units on 31/3/2019. Next, note 2, analysis on 31st March 2018. Analysis of 31/3/2018. Same thing. Opening units is A. Opening units A. Opening units A. Dividend in rupees is A into what is the dividend rate? A into 10% into 10 rupees. A into 10% into 10 rupees becomes A again. A into 10% into 10 rupees into 10% into 10 rupees. Dividend in units is A divided by something. How much? A divided by 50. A plus A divided by 50 is 20910 now. A plus A divided by 50 is 20,910. Any doubts on the calculation? Anybody has any doubts on the calculation? A plus A by 50. It is a slightly longer calculation. There's nothing complicated, but yeah, calculation will take away a lot of time. Let me know what you get to say. 20,000. We'll fill the table above. 20,500. Again, I'm repeating, table is not needed. Even if you do this analysis properly, that is sufficient. Exam is, the table is for two purposes. One is verification, and second, it's easy to visualize the transaction. Easy for you to visualize the transaction. $20,500 into 10% into 10. We got allotted extra 410. 31st March 2017, you will do it. Analyze 31st March 2017 and let me know the opening units. Again, you will assume it as A and then do. 2017 part you will have to complete. Assume as A and then do it. Do the analysis of 31st March 2017. How much? Okay. Dividend in rupees is, what is the percentage? 12%. So 1.2a. The NAV is 1.2a by 48. A plus 1.2a by 48 is equal to 20,500. A is 20,000. Any doubts on this? Any doubts on 20,000? Clear? Can you proceed? I think I'm kind of done with the dividend plan then. We write the opening balance as 20,000. 20,000 into 12% into 10 rupees. 20,000 into 12% into 10 rupees. Dividend in units is 500 and 20. Again, I'm repeating, this table is not really needed from an exam point of view. I'm ending with, basically when I invested, I got 20,000 units. When I did my first investment, I got 20,000 units. Now it's easy to understand. You started with 20,000, earned extra 500 units, earned extra 410 units, earned extra 697 units, and you have ended with 21,607. You ended with 21,607. Any doubts on this? So the requirement was calculate the issue price. So issue price is equal to 9 lakh 20 divided by 20,000. 9 lakh 20 divided by 20,000. That was the price at which I got the allotment, which is I invested at the rate of 46 in the dividend plan. At the rate of 46 in the dividend plan, no concept of taxation and all brought in here. Any doubts on this? Second is a bonus plan. Again, two stage calculation. First, we'll calculate what is the closing units, then keep reverse working and go to the opening units. Note 1, computation of maturity value. Computation of maturity value. The only thing is I'll have to add same format. I'll have to do percentage. Sale value less amount invested, holding period return in rupees, in percentage. In rupees and then percentage. In rupees and percentage. Two stage calculation. We'll have to do rupee terms as well as percentage. What is the return they have given? Again, that's average, okay? So 6.4 into 5 years. 6.4 into 5 years. 6.4 is the annual return. If you want the holding period return, you'll have to multiply with the number of years. 32%. 6.4 into 5 years. What is the amount invested? 10 lakhs. So my return is 10 lakh into 32%. 10 lakh into 32%. 10 lakhs into 32% is the return I'm earning. 10 lakhs is the amount invested into 32%. Break down the sale value into units into the closing price. Break down the 13 lakh 20 as units into the closing price. Any doubts in the calculation? I've been using the same format. If there are doubts in the computation, let me know. Any doubts in the computation, please let me know. What is the closing NAV given in the question? So what into 44 will be 13 lakh 20? So closing units is equal to 13 lakh 20 divided by 44. 13 lakh 20 divided by 44, 30,000 units. Bonus is slightly easier to do. Bonus plan would be slightly easier to complete. Any doubts on 30,000? Can you proceed? Any doubts on this number? Now listen for some time and then you do it. What is the starting date of allotment? First date. 1/4/2000. Okay. First bonus date. 31st 12. What is the bonus ratio? 1:2. The next one. Ratio. Anything else? Okay. So only two dates I'll have to analyze. It's a fairly simple calculation here. What is the closing balance you got? You got a closing balance of 30,000. You can do the calculation. This is A. This is 1 by 5A. This is A and 1 by 5A is equal to 30,000. A plus 1 by 5A is equal to 30,000 because the bonus ratio is 1 by 5. The bonus ratio is 1 by 5. Get the answer to A. Then analyze the earlier period. Then we get to the last calculation. So do this table first. Date, bonus ratio, opening balance, addition, closing balance. We are ending with 30,000. A plus 1 by 5A. Basically A plus 0.2A is equal to 30,000. You will get the answer to A, which is the opening balance addition. Reverse working, you will get the answer on 31st December 2016, and accordingly the solution will be analyze the December 2018 period. A plus 0.2A is equal to 30,000. A plus 0.2A is 30,000. 0.2A is 30,000. Let me know what do you get as A. How much? If anybody needs an explanation, please let me know. A plus 0.2A is 30,000. A plus 0.2A is 30,000. $25,000 plus 5,000 is 30,000. Clear? Again, A plus some number. A plus 1 by 4A. A plus 1 by 4A is 25,000. Let me know the opening balance. We purchased 20,000 units on day 0. We have purchased 20,000 units on day 0. Our purchase was for 20,000 units on day 0. The opening purchase was for 20,000 units. Any doubts on this? Clear? Can you proceed? The opening purchase was for 20,000 units. Issue price 10 lakh divided by 20,000. 50 rupees. 10 lakh was my investment, divided by 20,000 units. Divide by 20,000 units, 50 rupees. Any doubts on this? Clear? Can you proceed? Any doubts on this part? We did same problem earlier in the normal manner. ICA twisted the question and made it as a reverse working. They made it as a reverse working question. Any doubts on this? Then is homework. 10, 11, 12 is homework. 10 and 11 is same reverse working question. More for practice. 12 is something we'll be able to manage. It has some new concept as well. 10, 11, 12 is homework. Okay, we're kind of done. I'll just summarize what we did in today's session. We first started with understanding what is mutual fund, why mutual fund is needed. A mutual fund is basically going to pool money from multiple people and invest as per the scheme objective. They may invest in equity, they can invest in debt, they can invest in bonds, they can invest in multiple forms, gold or other instruments which they agree on. Now, the first thing from a problem solving point of view, I want to know how much should the mutual fund earn so that it is able to give me a target return. What is target return? Is my own return. So if I can invest and get 15% return, the mutual fund should give own return divided by 1 minus initial expense ratio plus the annual expense ratio. So if 12% is what I need, the MF has to earn 14 or 15% so that I am able to generate that 12% return. If NAV is growing by 12% in a question, that basically means that is the return the MF is giving. That is the final return the MF is giving. Second part is we did a problem where what happened is because I'm investing on my own, I had to spend some time. That type of a problem you cannot solve it using the formula. You will have to do a cost benefit analysis and then get to the answer because there is a opportunity cost for the time element. Then we saw how do we calculate return. There are two forms of return. One is called holding period return and second is called annual return. Holding period return is equal to NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 100. You do into 12 by M, it will become annual return. This annual return can also be calculated as IRR. But for us to do an IRR calculation, I need the number of years as a whole year. Then I can try to compute the IRR part. Now, there can be a dividend payout, there can be a dividend reinvestment. Payout, the formula remains same. Reinvestment, if it happens, the formula is what you get back, closing value, minus what you give, opening value, divided by the opening investment. Closing value minus opening value divided by the opening investment. That is going to give you this number. Now, closing value is opening units plus any extra units allotted due to reinvestment. And multiply with the closing NAV. You are going to multiply this with the closing NAV. Investment is opening NAV into the opening units. This you will do the calculation and then get to the answer. Now, how do you get dividend in units? Is first you calculate dividend per unit, then dividend for number of units. Dividend is always on the face value. Get the dividend in units, divide by the reinvestment NAV, you will get the dividend in units. Some question may specifically ask you whether payout is better or reinvestment is better. Logically, both are not comparable, but in an exam question, whichever is giving you higher return, you go ahead with it. If your reinvestment NAV is equal to closing NAV, both will give same. Reinvestment NAV was lesser, then reinvestment is going to give a higher return because reinvestment happened at a lower rate, closing is at a higher rate, and vice versa. Then there could be return calculation for a growth plan, for a bonus plan, and a reinvestment plan. Growth plan, very simple. You take the opening units as the closing units, multiply with the NAV, subtract securities transaction tax, no STCG, sorry, no LTCG. If LTCG is exempt, then no problem. STCG will not come. For a growth plan. Most probably it will be more than a year kind of a thing. If there is an LTCG, then you will have to calculate LTCG. When you calculate LTCG, cost of acquisition will be the opening units, whatever price you pay. STT is not allowed as a tax deductible expense. For a bonus plan, we'll have to calculate the closing units, which is opening units, addition, closing units, addition based on the bonus ratio. For a bonus plan, any units allotted in the last 1 year, STCG will be applicable, short-term capital gain. For short-term capital gain, cost of acquisition is taken as 0. I give you a work, please look at your income tax act or whatever you do that check and then let me know what should be the cost of acquisition for bonus units. Then when it comes to your dividend reinvestment, we start with the date of reinvestment. We have opening dividend, whatever the dividend rate, opening units will be there. Dividend in rupees is opening units into face value into the dividend rate. This will get reinvested at some rate. This will get reinvested at some rate. You will get the dividend in units, which is the closing balance, and then add it. Dividend in units and then add it, and you will get the closing balance. This you'll have to keep doing it. We can have a reverse working situation where we have to work with the last units and then go in the reverse order. With this, I'll end today's session.